it's your Shopee wallet, right?
Right,
So like,
okay.
your Grab wallet,
Right.
They treat it as deposits.
Right.
I'm not sure if this is legally allowed, but that is what it is. Right?
All right, Aaron. So here we are on a new episode of the Economy Rise. How are you doing?
I'm good. I'm enjoying my economy rise right now.
Yeah, it is so economical that it has nothing.
And it's a good metaphor for our rice bowl right now, right?
It is literally just white rice. Okay.
So I'm Aaron,
And I'm Hardish.
and here today we are Economy Rice Podcast, and we're here to discuss things related to your rice bowl.
Yeah, there have been requests from our growing fan base to start sort of really understanding things from a finance perspective, right?
Right.
And I also think that quite a number of our followers are also from the finance industry or aspiring to move into this industry. So we think there is an opportunity, especially with Aaron's background and expertise, to talk about things from a financial perspective. And what I mean by that is really to look at company finances, right?
Right.
So my background, I work mostly with startups, all right? So the information that I work with is very different.
Right.
Of course, there are some sort of, the basic level of understanding, right, from a business perspective. But I think that is no way as deep as what you would go when you sort of look into public companies, right?
Right.
So, I'm also keen to learn this a lot more, to really understand what's going on when we look at all these numbers. So I'm benefiting, and hopefully the viewers will benefit as well. So, Aaron, maybe my first question is from a very top level. When we look at public listed companies and we want to analyze their reports, right? What are we actually looking at? Because there are a few parts to it, right? So maybe you can just give a summary in terms of what they are.
Right. So most people will be concerned with the three statements, which is the profit and loss statement, the balance sheet, and the cash flow statement.
Mm-hmm.
And similar to small businesses, at the end of the day, what we are looking for is the cash in, cash out concern of the business,
Yeah.
right?
Yeah.
So think about your small business. You put in a certain amount of money, you expect to get a return out of it, and businessmen normally describe that as number of years to break even.
Yeah,
Right?
ROI.
Right,
Okay.
ROI. It's actually just the concept of ROI.
Okay.
In finance, we call it the PE ratio, right?
Okay.
It's the same thing.
Okay.
So, end of the day, right, however complicated it may be, it can be boiled down to figure out what is the cash in and cash out,
Okay.
and then figure out what is the future cash in and cash out.
Okay. Okay. And the future cash in and cash out will be an indicator of the health of the business, right? So that is why
Yes.
you're interested to sort of understand it from a longer time horizon.
Basically, it's just what a normal businessman
Yeah.
would think about. Yeah.
Okay. Can I make money or not?
Yes, right?
Right. Okay. Okay. So
I mean, whether it's Apple or, Silterra.
Okay.
Right.
So what are we looking at? So we have right here the cash flows from operating activities, right?
Right.
Is that would that typically be the first starting point for any report?
The answer to that would be no, because
Okay.
normally you look at profit and loss statement, but I think for the purpose of this explanation,
Okay.
we can say the answer is yes.
Okay,
Right?
okay.
Because what you're trying to do is, again, figure out the cash in, cash out.
Okay. Okay.
Right? Yeah.
Okay. I'm all ready to learn.
Right.
So you wanna take us through it?
So keep in mind, this is going to be a simplified explanation, right?
Yeah.
If you really want the full-blown details,
Sign up for our course. coming soon.
yeah, okay. But to really understand what we are trying to do, right, it's important to break down what the cash flow statement is. And I'm just
Yeah.
trying to keep it as brief as possible.
Yeah.
The cash flow statement is made out of three types of cash flows: operating cash flows, investing cash flows, and financing cash flows. So we've already done operating cash flows. Investing cash flows are more concerned with longer term investments, so capex,
Yeah.
right?
Okay.
And we want to separate that from operating cash flows because then it's easier for investors to analyze.
Okay.
And then the third one will be financing cash flows, which is more concerned with the return of the investor. The investor puts in a certain amount of money, gets out a certain amount of money. And there are two broad categories of investors: equity investors and debt investors.
Okay.
Right? And then at the end, you just get the end cash balance of the company. But I think what is more interesting to the viewers will be how does this tie back to the other two statements,
Okay.
profit and loss and the cash flow statement.
Okay.
So if we look at Sea Limited's profit and loss statement, right?
Okay. So we're starting with profit and loss now, right?
Yes.
Okay.
So that will be a few pages up.
Okay.
So the profit and loss statement is basically just the accrual version of the cash flow statement. And what do we mean by that? So if you think about something, a small business, or even Starbucks, right? Normally the cash in and cash out is very straightforward.
Yeah.
But when you get to a CIMW or Maybank level, it can get very, very complicated. You can have different cash flows in different years, but belong to another year. So for instance, capex. You are investing in an asset that lasts you 20 years, but you want to allocate the cost across 20 years. So we call that depreciation.
Okay.
Do you see what I mean by
Yeah.
accrual basis versus cash basis? So the profit and loss statement is meant to simplify all the cash flows that belong to a particular year, right? Cash in and cash out, to that reporting period, let's say financial year 23. So at a glance, right, the investor can tell, or the stakeholder can tell, okay, what was your cash in, cash out attributable to that year?
Right.
You don't need to go and, go through the minefield and figure out which one belongs to which year, right?
Right.
From the cash flow statement.
Okay.
But fundamentally, it is describing a cash flow statement.
Okay.
Follow up to that would be the balance sheet. So
Okay.
if you think about the concept of accounting recognition, it's a double entry concept, right?
Okay.
Where you have a debit and you must have a credit somewhere.
Okay.
Whatever doesn't end up in the profit and loss statement will just land in the balance sheet. It's like a stasis or a reserve account.
Okay.
And it's basically just meant to keep track of stuff, right?
Okay.
So in that way, the three statements work together to form a picture to the reader about what is the true cash in, cash out performance of the company.
Okay.
So let's say if you as a businessman were analyzing one of your small businesses, right?
Yeah.
You would just have a very straightforward double ledger, right? Showing all the cash in and cash out, and then a summarized ledger, right? By your accounting software.
Yeah.
When you get to millions of entries per year, right, or even JP Morgan trillions of entries, you just want to summarize it, and this is how you make sense of it,
Okay.
right? So you are just reverse engineering to get to the same level.
Okay.
So if you look at Sea Ltd, right?
Okay.
So they are
This is again the profit and loss, right?
this is the profit and loss.
Okay.
Yes.
Okay.
So of course they are earning revenue,
Yeah.
and I think a bit of context is required. We need to know what business they are in first,
Yeah,
right?
okay.
Because even though IFRS accounting standard standardizes all the presentation, different business obviously for the same number will have different contexts.
Right. Okay.
If AirAsia had this amount of revenue and Sea Ltd had this amount of revenue,
Right.
it would imply different business things, right?
Yeah. Okay.
So we start with the revenue because that is what they receive.
Okay.
So digital entertainment is their gaming company,
Right. Okay.
and then they have the e-commerce company,
Yeah.
right? And
okay.
also
Shopee.
Shopee. Yes, we are very familiar with Shopee, right?
Okay.
So when you pay,
Actually, some people might not know that it's Shopee is owned by.
yeah,
Sea
we should have
Ltd.
said this at the start, right? So anyway, okay. So the thing is that the bulk of Sea Ltd, trust me, right, is going to be Shopee in the future.
Yeah.
So let's just simplify and pretend that the whole company is Shopee.
Okay,
Because
okay.
anyway, we are just trying to explain.
Yeah.
We're not even trying to analyze the company.
Yeah.
So revenue is basically whatever income they generate, right?
Yeah.
When you pay Shopee, right, you contribute to their revenue.
Yeah.
And this is what I mean. What I'm going to tell you is what I meant just now by there is nuance to it. So think about when you pay on Shopee, the platform. The bulk of your money is actually paid to the seller on the platform, right?
Yes.
Shopee just takes a
Yes.
commission.
Yes.
So the revenue that you're seeing here is just the commission, which is
Yes.
around 9%, if I'm not
Right.
wrong.
Okay.
Right?
Right.
It is not the full gross
Amount.
merchandise value.
Yeah.
Right? So do you see what I mean?
Yeah.
That there is nuance,
Yeah.
right? And then if it's AirAsia, it's a totally different answer.
Yeah.
If it's Starbucks, it's a completely different answer, right?
Yeah.
So the point is that you want to reverse engineer to the truth, right? And you can treat it as a map.
Yeah.
The next one,
But just to clarify, this
Yes.
in this case, right, where they report the revenue, right? So revenue is income. These numbers here is basically that commission or the overall revenue that they collect.
okay, so
this-
we just take,
Yeah. So this will be just commission in this case.
to keep it simple, yes.
Okay.
Right? And we're
Okay.
just talking about the e-commerce line.
Right.
Right?
Okay.
So for instance, the digital entertainment, their revenue would be, I think also commission.
Okay.
Yeah.
Okay.
Right?
Okay.
So okay, just to add some color to it, right?
Yeah.
Put some meat on the bones. The digital entertainment is a gaming platform where
Yeah.
they sell games
Yeah.
and also host microtransactions.
Yeah.
So anytime you buy a game from a publisher, you will pay them a 30% fee, similar to Apple's App Store. And every time you pay for, let's say, a boost to your hero, they will also collect 30% on it.
Okay.
Right? So you can tell that even though they are put side by side, the e-commerce only collects 9%. The digital entertainment collects 30%. See how once you work backwards, there
Yeah.
are very different nuances.
Yeah.
Right.
Okay. So anyway, just to move on. So basically, this e-commerce revenue captured here is just the commission portion, right?
Yes,
Okay.
effectively.
Okay.
Then we move on to cost of revenue.
All right.
So in most other companies, we call it cost of goods sold, all right? But let's just go with this, right? And then when you deduct that from revenue, you get your gross profit.
Yeah.
So what's gross profit? Think about if you buy coffee from Starbucks, right? The product that you're getting. So the revenue is what you pay, and the product is just the cost of the ingredients,
Yeah.
without factoring in other things not related to the product, like the salaries of the employees, the rent that you are paying, right? Those do not fall under cost of revenue.
Right.
So that's what the gross profit really means.
Okay.
Yeah.
So
And-
far, so good.
So far, so good, right? Okay. And, if you guys have any questions, please leave them in the comments. And if you're enjoying this episode, please remember to like and follow this channel.
Okay.
Okay.
So then we go to operating income, right?
Yes.
Or expense, right?
So the operating income will be what I was saying earlier, right? The cost related to the business outside of the product. So think about Starbucks, rental, your employee salaries, right? EPF, right? Stuff like that. But notice how rent is not sold to the customer,
Yeah.
right? It's part of your business cost, but the customer doesn't, strictly speaking, benefit from it. That is why we put it under operating expense, not cost of revenue.
Okay, I have a question here. So this is where probably it's a bit different from the sort of numbers that I typically look at, right? So here,
Perhaps.
okay, so it says operating income and then bracket expenses. And then at the bottom, there's operating bracket loss income. In both the top and the bottom, there's actually operating income, right? What is the difference between the two?
Okay, I think they are.
Or is it
pretty
just a
much the same.
labeling, right?
Yeah, because if you look at the top, they are talking about the operating expense. Then
Yeah.
they sum up the expense.
Right.
Then you deduct the total operating expense from the gross profit to arrive at the actual operating income.
Mm.
Right. So they are just breaking out or rather summing up the operating expense.
Right.
Right. So in fact, I think most companies don't do that.
Yeah.
Right. So that may be where the confusion might stem from.
Okay.
Okay, so for the audience benefit, operating expense, even business people shortcut it to OPEX.
Yeah.
So that's what we actually mean, right, when we say OPEX. And currently, there isn't any real problem, but let's go back to 2021, right? I'm not sure if we actually have it. Yes, we do.
Okay.
So if you look at the operating expense of 2021, the sales and marketing expenses, and you divide it by the total revenue, you will see that the amount is something like 50%. Right? And that is very high, right? At one point, so you see the sales and marketing expense here, right?
Yeah.
Is the group expense.
Yeah.
If you break it out,
This
this
is
number,
in billion, right?
this
Actually,
is in, no. Wait. Yes,
three-
in billion.
It should be the
Sorry,
unit
in
here
thousand,
should be
in thousand.
in thousands. Yeah.
Yeah.
So basically 3.8 billion lah.
Correct.
Right.
And this
Operating
is US dollars.
sales and marketing expense 2021 was 3.82 billion.
Yes.
Right. Okay. And you're saying the total revenue was just shy of 10 billion lah.
Yes.
Okay.
And actually, if there's a different page which I'm not showing now, it actually breaks out the sales and marketing expense.
Okay.
So if you actually take that year's sales and marketing expense for the e-commerce segment and divide it by the e-commerce revenue, you will find that the ratio for Shopee's sales and marketing expense to revenue is almost 70%.
Right.
Which,
Yeah.
So
Yeah.
let me just use a very simple analogy, right? Let's say I started a hawker store, right? And I'm selling, I'm growing my revenue, right? My sales at, some very high rate at doubling every year. Then it might sound great, right?
Yeah.
But when I actually look at how I'm achieving it, you notice something. I'm selling everything at 70% below of my competitors.
Right.
So is that impressive anymore? No, right? And actually, even from this page, you can tell how exaggerated their sales and marketing spend was at the time.
Yeah.
Because if you look at 2023, sales and marketing expense is 2.8 billion.
Yeah.
Whereas their total revenue actually grew to 13 billion. So it went in two different directions. That just shows that it has become much more normalized today.
Okay.
If I'm not wrong, right, the current sales and marketing expense is closer to 30%,
Okay.
right?
Okay.
For context, brick and mortar retail, the big box retailers, they tend to spend about 40% on sales and marketing of revenue. And established e-commerce sites like Amazon, they tend to spend closer to 10 to 15%.
Oh, okay.
Right?
Right.
So, even now the 35% is still high,
right.
but let's be fair, Sea Ltd is not established yet.
Yeah.
And, the 70% of yesteryears, right, is just ridiculous.
Right. Okay.
Right? So
Okay.
this is how you can assess as a businessman
Okay.
whether your company, right, presumably you are a shareholder, you are owner of a company, is performing to your expectations,
Okay.
right?
Okay.
Yeah.
So how would I make that judgment? Like, so taking that as an example, right? So the sales and marketing is basically the overall sales and marketing, right?
Yes.
For the entire business. So the entire business is partly Shopee and partly the gaming, right?
Yes.
So, but what you've done is that you've broken out the ratio, or you're sort of comparing what they're spending on sales and marketing versus just the Shopee element, right?
Right.
How would someone make that judgment, and why in this case do we look at it from that point of view?
Right. Okay. So the reason I'm not showing it now is because it will take some time to search it. But they actually do disclose in a separate page,
right,
which segment spends how much in sales and marketing.
Right. Okay.
And the reason why we do this is because you want to know which spend is attributable to which business.
Right. Okay,
There's no point comparing the gaming spend to the e-commerce business.
Right. Okay.
Yeah.
Okay. All right.
And I think also, right, just since we're talking about it, right, one of the very useful methods that financial analysts use is something we call margin analysis.
Mm-hmm.
So sales and marketing to revenue is a very good example of it. You're just dividing one field by another field. And when you do this, think about it, imagine an Excel spreadsheet, right? You will just key in all the data, fill in all the formulas, and then what's the remaining? What do? You just drag,
Okay.
right? So it's very simple to do. And by dragging like that, you have a bird's eye view and you can see where the outlier is.
Okay.
Right? Immediately a 70% sales and marketing figure to revenue would stand out.
Right. Okay.
Right? And that's how you assess it.
Okay.
Yeah.
Okay. Okay. No questions on that. What's next?
Okay. So following that will be your non-OPEX,
Right.
right? Non-operating expense. So that will be like your interest income, your investment income, right? These are non-related to the businesses, right? Typically they fall under investing or financing cash flow. But on the profit and loss statement, they also financial standards require it to be separated from operating expenses.
Okay.
And then finally you have your tax, and then you have your net income.
Right.
So net income is your net profit. I think it's quite self-explanatory.
Right.
So
Okay. So that's the profit and loss.
okay, sure.
Okay.
So
Then.
I think it's quite useful at this point to so in the profit and loss statement, there is another statement called other comprehensive income, right below it. So you can see on this page, but I will not be going into it today because it is quite complicated.
Okay.
Okay. Just know that
Can
it
you
exists.
just summarize what this is?
Okay, so basically, think about if Sea Ltd invested in treasury bonds. Right?
Okay.
So it would have mark-to-market fluctuations.
Okay.
And if you account for that in the profit and loss statement, it will make it very volatile.
Yeah.
And someone looking at the net profit would have an unfair view of the neutral profit.
Because it's volatile, you never know
Yes.
the position. Okay.
So IFRS specifically allows 6 types of transactions to be under other comprehensive income.
Okay. But something like fixed deposit that they're using just to park cash, that wouldn't fall in here, right? Because
So I could go into it, but trust me, it's very complicated.
Yeah, no problem.
Okay, so since we just finished talking about the profit and loss statement, let's come back to the cash flow statement.
Okay.
You can actually tell that a lot of what we saw in the profit and loss statement can be attributed back to the cash flow statement. So remember again, why did I start with the concept of cash in, cash out? Because ultimately when we analyze the profit and loss statement, we want to see in a simplified manner, right, or in a accrual basis, what is the actual cash in, cash out of the company. Right? It just helps us look at it much more simply.
Yeah.
And you recognize the pros and cons on both, right? So the cash flow statement, it will be much more accurate, but it will be much more complicated. Profit and loss statement will be much more simplified, but it has some weakness, it will be less accurate.
Okay.
So by comparing both, right, and pretending they are one statement, you get to the truth of the cash in, cash out of the business.
Okay.
Right? And if you have the knowledge to do that with accounting standards, it's quite simple.
Okay.
Yeah.
Okay.
So, for instance, right, let's just give one example. If we look at operating cash flows, they mention depreciation here. So we know where depreciation is, right? It falls under general and administrative expenses. So then you can attribute that back to the P&L,
Okay.
right? And then you do that for every single thing that is relevant.
Okay.
End of the day, what you're trying to do, find the cash in, cash out.
Right. Okay. Okay.
Okay, so let's go to the balance sheet. And what is the balance sheet? Think about the concept of cash in, cash out. Obviously, there are going to be a lot of things left out of it, right? For instance, let's say you buy FD. This is Sea Ltd invest in treasuries.
Okay.
Yes, it will be recognized as a cash outflow under the cash flow statement, but notice that there is no profit and loss entry
Yeah.
because there is
not
no
a
profit and
business.
loss
Right.
situation.
Right.
You are taking capital and investing it, but there's no yield involved.
Okay.
There's no return on it. So the investment income will appear in the P&L, but the capital stock that is invested in treasuries, where does it go? It goes to the balance sheet.
Right. Okay.
And the balance sheet is something like a reserve account.
Right.
It's a bit like a stasis account,
Mm-hmm.
right? Where basically any cash in or cash out that is not recognized in the profit and loss statement sits on the balance sheet until it's turned,
Right. Okay.
or after it's turned. So I'll give you a great example. Net profit, right? It is obviously a profit and loss
Yeah.
account. What happens to net profit? It goes to retained earnings, right? What is the retained earnings in real life? It's actually just the cash sitting in your bank account, right? And what do shareholders want to do with that cash? They want to take it back for themselves, right?
Right.
Correct. We call that dividends.
Right.
So this will be netted off from a balance sheet, debit retained earnings, credit cash,
Okay.
right? But notice that it has already passed the profit and loss statement. So everything needs to flow through the profit and loss statement eventually.
Okay. Okay.
So every form of return or loss needs to flow through the P&L account. Anything that is not doing that, but is a cash in or cash out nature, will then flow through the balance sheet. For
Right.
instance, dividends.
Okay. Okay.
That is a great way to describe it.
Okay. Okay.
So by putting all the three accounts together, ultimately, you as a businessman, as a very sophisticated big businessman, are looking at the three accounts as one single account with the end goal of just trying to understand what is the true cash in, cash out.
Right. Okay.
That is all it boils down to. And that is how CEOs read their reports. That is how CFOs read their reports, right? Of course, they will have more granular in-house data,
Yeah.
but they will start from here as well,
Yeah.
right? Then they will drill down. Think about if you are CEO of AirAsia, Tony Fernandez. Obviously, he could, ask his CFO to explain everything. But if he didn't, he will be looking at it the same way, right? He's not thinking in terms of maybe how some analysts look at it.
So just one look at this. I mean, now we are at the balance. We are at the balance sheet, right?
Yes.
Anything of interest here?
So I think something that is quite relevant to Sea Ltd would be their deferred revenues.
Okay.
Okay. So if you look at Sea Ltd's balance sheet, right, you will notice that they have three very unusual current liabilities, right?
Okay.
The first one would be deposits payable. You can see it's a huge sum. It's 1.7 billion. Escrows payable, 2.2 billion. And deferred revenue, which is 1.2 billion. And what are these and why do I say that they are unusual? So you won't really find most of these in most companies, right? And what these are is,
Can I take a guess?
Yes, go ahead.
Deposits payable.
So think about Shopee, right?
Yeah.
How you as a customer pay.
Yeah. So are they basically delaying the commission payout? So they're holding on to the
Yes.
commission?
Yes, and why? Have you bought on Shopee before?
Not really lah.
Okay.
But if I were to guess, it's maybe because if I have a complaint or I need a refund, right?
Yes.
So they want to hold on to this cash before it leaves,
Yes.
so that a simple analogy is that they can control it lah.
Yes. So you are right? So for the deposits and escrow payable, they are related to Shopee, the e-commerce business.
Okay.
Deposits payable is very simple. It's your Shopee wallet, right? So
Right,
like,
okay.
a Grab wallet,
Right.
They
Okay.
treat it as deposits.
Right.
I'm not sure if this is legally allowed, but that is what it is, right?
Okay.
I'm
So basically,
sure-
it is
sure
how much money sits in this wallets lah, right?
Yes. Right?
Technically, if people don't withdraw, it just sits there. right?
Yes.
Okay.
And what can you do? What can be done with it if it just sits there?
I mean, I'm assuming they can invest it if they wanted
Correct.
to.
Yes, it's basically a form of interest-free loan.
On that note, I'm not going to name any names, but I have a big complaint with a lot of these wallet providers, right?
Right.
That it's not so easy to withdraw, you know? Like, just say if you have a small amount, even like if it's 5 ringgit, right?
Right.
It's not so easy to like withdraw it.
So what's the difficulty that you experience as a consumer?
Like as a withdrawal, I don't believe, I haven't checked in a while,
Okay.
but you know, when these wallets were first introduced, right? It's not a e-wallet like your payment wallets lah. This is like basically to store credits, right?
Okay.
To be used for the services within the app, right? That is kind of like in this case also, right? You top up your wallet so that you can use it to use within when you do e-commerce shopping and stuff like that, right?
Sure.
So basically you top up, right? It's
Yes.
kind of analogous to your prepaid debit card lah in a
Yes.
way, right? So you can put in money, but in my experience, you just say you log in and you see like you have 10 ringgit there. It's not so easy to ask for it back.
Okay, so they make you jump through hoops.
Yeah.
Okay.
Yeah.
Yeah, I mean, that's legal, right?
Yeah.
So, well,
So anyway,
I
those are all
sympathize.
the deposits there.
Yes.
And probably some of it is also people don't know that they have some cash sitting
Yes.
there, right? They just forget.
No, in fact, a very big business model of many companies
Right.
is to have your 10 ringgit sitting there
Yeah.
and you just forget about it.
Yes.
And also gift cards that expire.
Yes.
Right? In fact, there's a specific accounting term for it. We call it, okay, I can't remember what it's called, right?
Okay.
But it is so prevalent that there's a proper accounting recognition
Wow. Okay.
policy for it.
Okay. So
So-
that's deposits payable. Okay.
Yes.
You were saying there's something else.
So escrow payables.
Escrow.
So if
Wait,
you are
where is escrow? Where is
right below
second one,
deposits.
right? Okay.
So escrow payables is even larger. It's 2.2 billion.
What would escrow in this case be?
So let me explain. If you are a frequent purchaser of Shopee, you will know that you have 15 days to make a complaint and get a refund, right? And in fact, Shopee has just introduced the same concept as Amazon, which is sellers can choose to allow refunds for any reason. So it's very competitive right now.
Okay.
So what these escrow payables represent is the amounts attributable to that 15-day refund period.
Right.
Because if you think about it, right, they're just holding the amounts on behalf of
Yeah.
customer. And how do you arrive at this 2.2 billion? It is taking basically the annual amount, dividing it by 365,
Okay.
5 days, and then multiply by 15 days.
Right.
Right?
Okay,
And if you
okay.
compare that to your actual e-commerce revenue, you can see the relationship between the gross merchandise value and the take rate or the commission. There should be a like-to-like relationship.
Okay.
That is also a form of interest-free loans,
Mm,
right? Think about how important working capital is to a small business.
Yeah.
This is how big businesses have advantages.
Yeah. So technically, they could tap into these funds, right?
Not technically, they can. They
And-
literally
and they,
can.
And they do lah, probably.
They can. So let me put it this way, right? Let's say they run into some cash flow concerns and they only need 15 days to solve it, right? It's a difference of life and death.
Yeah.
They can literally drain this,
Right.
Wait for 15 days to come in the new one,
Right.
and then pay it back. There is no ring fence involved, at least as far as I understand.
Okay.
Okay, that is really the advantage that big businesses have over small businesses.
Okay.
And then finally, we come to the deferred revenue. So this is also a similar nature of cash flow, but this one is coming from. You want to guess where it's coming from?
Deferred revenue.
So I'll just give you a hint. This one is not the e-commerce business.
No
Okay.
idea.
So this one, remember what I was saying? What the game business was?
Yeah.
Is a gaming platform. They do publish their own games, but it's predominantly to publish other people's games. So if I am as a gamer, right, I want to buy the game, I would first need to deposit money into the wallet, the gaming wallet. But uniquely, I cannot withdraw. Once I put it in, it's converted into a gaming
Credit.
Sea Ltd currency,
Right.
right? And I cannot withdraw. I have to spend it somehow.
Right.
This is why it's not falling under deposits payable.
Okay.
Unlike
Okay.
the e-wallet, right? You may have the jump through hoops, but you can withdraw eventually. This one, once you put it in, it's gone already. You must spend it in the platform somehow.
Okay, but why do they say it's deferred? Because they've already captured it. What's the defer here referring
Okay,
to?
so in the sense that it's like a gift card, right?
Right.
Once you put the money in, it is actually effectively revenue
Right.
because you must spend it,
Yeah.
right?
Yeah.
Or it goes expire after several years.
Right.
And but at the same time, it is not revenue today because you
They
are
haven't
just putting
spent
money
it.
in.
Right. They haven't spent it.
You haven't bought a game, right? You haven't
But-
consumed.
But they are, because they can't take it out, so you assume they have to spend it, so therefore it's a deferred revenue
Yes.
on the revenue side.
So think about if, let's say you bought a coffee from Starbucks, what would double entry be? It would be debit cash,
Yeah.
credit revenue,
Yeah.
right? So in this case, it will be debit cash, credit deferred revenue. Then when you spend your gift voucher, it will be debit deferred revenue, credit revenue.
Okay.
See what I'm saying?
Yeah.
So do you see what I mean when I say that it's all about cash in, cash out?
Yeah.
It's a very complicated version of it. But at the end of the day, right, the essential nature is cash in, cash out. There's nothing rocket science about it,
Okay.
right?
Well, there's a little bit of rocket science. You
Yeah,
gotta
I mean the
understand-
IFRS. Yeah, okay.
You got to understand the context of it, which I think
yes.
only someone who understands that particular industry would, right?
Yes.
So, like someone like me looking at this for the first time, I wouldn't understand it, but with a little bit of just understanding the business, thinking about it, then you can sort of make some guesses in terms of what this different items refer to, right?
Right. But notice how
but-
I was able to explain to you
Yeah.
what it actually is.
Yeah, yeah.
I didn't need to use metaphors.
Yeah,
Right?
yeah.
It's not like actual brain surgery.
Yeah.
Right? Yeah.
Okay. All right. Yeah. Very interesting. Okay. Anything else, or before we wrap up?
Right. So we're not here to analyze stocks.
Yeah.
We're here just to explain how to analyze financial statements.
Financial statements.
So
Yes.
of course, beyond this, you'll be looking at different things like, is the valuation cheap, right? What is the business future going to look like? Maybe we can talk about that in future episodes,
Yeah,
right?
yeah,
Like
yeah.
how do you attribute the financial statement information to the business? But we probably won't be talking about the stock level stuff.
Yeah.
Right?
Yeah.
So at least from an accounting and financial analysis perspective, right? This is what you fundamentally need to know.
Okay.
One, it is about cash in, cash out.
Mhm.
Two, the three statements are meant to be read together as one statement. And three, it is no different from how a businessman reads it
Okay.
from a fundamental basis.
Okay. And if I can say within that window of cash in, cash out and understanding it, there's some room for creativity.
Oh, yes.
Right,
So keep
okay.
in mind that we are talking about purely good faith right now.
Yeah,
Right?
okay.
As long as you follow the accounting standards.
Okay. All right. Yeah, I think this is quite enlightening. And I think, in the upcoming episodes, especially for our viewers, what we hope to do is actually look at different companies, right?
Right.
So I think like this part where we actually really drill down on what some of these terms are and what they're referring to, I think that is the things that people don't often think of, right?
Right.
Until you actually understand the business. And I think that's of value to our viewers, right? To
Yeah.
basically just know more, right?
No, in fact, it's not even only of value to laymen.
Yeah.
It can be of value to even financial
Analysts.
analysts.
Yeah.
Because basically we are doing your work for you.
Yeah.
Right? And then of course we're not going to comment on the stuff we cannot.
Yeah.
But this is like half the work, right?
Yeah. Okay.
Yeah.
All right. Very interesting, Aaron. Thank you so much. So yeah, look forward to this particular new series that we're going to do. Every episode we will look at a different company. And if you have a choice of company as well, you can put it in the comments. We'll definitely be happy to look at it.
Right.
But I think fair to say it's all going to be public listed companies, right? For this
Yes.
particular ones. Yeah. Okay. All right. So with that, thank you so much. We look forward to seeing you again. And this has been Economic Rise Podcast.
And if you guys have any questions, please feel free to leave them in the comments. And don't forget to give us a like and a subscribe. We are happy to entertain any questions or any requests you might have. See you in the next episode.